Good morning. Welcome to day 99 of the lockdown. Over 11 million cases around the world. I can't believe we are halfway through the year, 6 months into 2020. And it's been an incredible roller coaster, ups and downs. So today I'm going to talk a little bit about the coronavirus, give you an update of where we are and what's happening in the markets. But also I'd like to look a little bit beyond that. The market tends to focus on one thing at a time. It has been COVID-19 has been the sole focus, but we are starting to get to that point when the market will find something else to look onto. And I think the big discussion that needs to happen is the dollar. So towards the end of the discussion, we'll be looking at that the dollar needs to strengthen or weaken, what that outlook is, and how that impacts our markets and our investment portfolios. But let's start off with some good news. Looking at the surveys of the funds, this is from the Alexander Forbes Multi-Manager Survey at the end of May. And as you can see there, a perfect scorecard. Over 1, 3, 5, 7, 10 years across all funds, #1 in every category. So you can be rest assured that the funds are doing well in the current high volatility, low growth environment. We firmly believe that our Japanification roadmap is working and will continue to work over the next decade as we expect this low growth environment to be with us. Difficult times, very, very difficult times to be invested, very difficult times to grow your pension so that you can retire appropriately, but we're doing our best to make sure that we can meet those goals. Similarly, comparing the Sygnia funds to the single managers, doing very nicely across all time frames, third and fourth over 1 year, second and third over 3 years, third and fourth over 5 years, and first and second over 10 years. A lot of movement between the single managers as they go through their cycles, and single managers tend to be very, very style specific or cycle dependent, whereas there's a lot smoother return from your balanced portfolios. So performance looking good, the fund's holding up nicely. As you can see there as well, over 1 year period, positive numbers, which is fantastic. 4% over 1 year for the Signature 70 fund, which is an amazing return given the volatility that we've had. Very excited to have absolute positive returns and capital protection in the current environment. So let's jump into economics and markets. It's still all about the virus. The IMF revised its global growth outlook lower. It now expects GDP growth to contract by 4.9% this year, revised down from 3%. So that's bad news. But at the same time, it's what's in the past, it's what we expected. We know things are going to be tough. Earnings that are coming through from companies, also historical, looking back, are horrific. Companies are struggling, earnings are collapsing, a lot of companies using rights issues. But again, that's looking back. If we try and look forward, the data is looking far more promising. And the markets tend to look forward most of the times. The PMIs, which are your forward-looking confidence indices, are bouncing very strongly. If you look at some of the real-time indices in the US, like the Philadelphia Fed and the Empire surveys, they're suggesting that the recession is over in the US. The fastest drawdown into recession and the fastest recovery from a recession ever. But we always knew that was going to be the nature of this recession, given that it was structurally created by governments and then structurally removed by governments as lockdowns disappeared. And we've seen that. We're now 8 weeks into a more mobile environment where we're trending towards the new normal. Both the Google Mobility Index and the Oxford Stringency Index are indicating that we're getting closer to the new normal, that people are leaving their homes, jobs are being started, and life is continuing. So the big question is, second wave, first wave, what is the impact on the economy? Are we going to continue to open up? Or are we going to get shut down? So the two charts on the right are key for this prognosis. The top chart, and both are from JP Morgan, thank you. The top chart shows the level of increases in cases since the lockdown. So now we've got 8 weeks worth of data, so we've got a much better understanding, much more likelihood that this reflects what's happening in terms of the increase in cases. And you can see there's still a majority of countries since the lockdown, since mobility increased, actually seeing a decrease in infection rate, not an increase. There are some cases, isolated cases, where the increase, there has been an increase since the opening of economies, particularly in the US. So the US is the worst country in the world when it comes to number of cases that are being seen, and particular Florida, Texas, and Arizona. Those are the three up here, which are seeing a far higher increase in the number of cases since the lockdown ended. So this could mean that we are seeing a second wave. It could also be that it's just the tail end of the first wave that hasn't quite ended. But regardless, what's most important is this bottom chart, which looks at hospitalization rates. When we initially modeled this virus in March, many months ago, it was expected that people who contracted the virus, that 20% of them would be hospitalized. That number is now closer to 5% in reality. And you can see there, this chart at the bottom, while there has been a slight increase in one of the states in the US, the number of cases in terms of hospitalization is nowhere near what it was in the past. So the fact that we're only seeing isolated hotspots that are coming through, which are either second wave hotspots or in emerging markets, it's that the end of the first wave, is comforting in that those increases are a lot slower than the increases we had in March and April. And more importantly, the fact that the hospitalization rates of that increase is much lower. And we can see the same thing in South Africa. We haven't seen a peak in the number of increases in cases in South Africa, possibly in the Western Cape we have, but certainly in the rest of the country, we're still escalating. But the hospitalization rates are much lower than modeled. So while there's still a constraint in hospitals, there's a lot less utilization than we thought, which is very important. It means that we don't have to go back into the extreme lockdowns that we were in. So I think generally, given the fact that we are only seeing hotspots and the fact that hospitalization rates are much lower than the past, that our base case is certainly that we don't get down to the previous lows of March. We don't have national lockdowns. We might have isolated lockdowns, but it will only be in the hotspots, maybe in cities, certainly not in countries or provinces. And as a result, your economies are going to continue to recover. And we're still expecting Q3 of 2020 to have a massive rebound in growth as the PMIs are showing. So very positive from an economic perspective, and supporting the fact that this is going to be not a V-shaped recovery, but certainly we're bouncing quickly from the lows. At the same time, we need to look beyond the virus at other aspects that are impacting the markets. The biggest one is certainly the US, where Trump is focusing on the November elections. He's dropped below Biden for the first time. So he has a 47% chance of winning the elections in November, whereas Biden is up to 53%. And knowing that he's in the losing corner, Trump could do anything to try and get re-elected. So he's continuing to focus on China. He's isolating China as the enemy, trying to rally his voters behind him by attacking China, focusing on COVID-19, focusing on trade wars. He's talking about sanctions and a number of other possible ways of punishing China. So that could lead to heightened volatility over the next 5 months as Trump saber rattles. So while at the one time we're moving out of the COVID-19 concerns and those continue to decrease as we're closer and closer to the virus, we're going to see increasing volatility from the US and from Trump as he focuses on his elections. So how have the markets done over the last 6 months? Just a quick recap. So once again, the markets are continuing to function efficiently, which is great. All the liquidity that's been pumped into markets, all the fiscal support is allowing markets to differentiate between the lockdown losers and the lockdown winners. The dark blue lines show the returns over the 6 months of 2020 up to the end of June. So the biggest loser is still South Africa Inc., as shown there with SA listed property, which is down 25% for the year, for the 6 months, even though it's bounced quite strongly, 23% for the 3 months from the 1st of April. So a very nice bounce, but still down 25%. And this is the same if you look at SA banks, SA retailers, SA property. Emerging markets, domestic stocks are seen as lockdown losers because emerging markets are not expected to be able to deal with the virus as well as developed markets. And the same is seen at the bottom there, where over the 6 months, the rand and other emerging market currencies are still very weak, 22% weaker over the 6 months, with a small recovery, 4% over the last 3 months, but still markets saying emerging markets as a whole are lockdown losers. If looking within equities, you can see that equities are still slightly negative over the 6 months, with S&P slightly positive, with a large bounce over the last 3 months. Again, that bounce has been driven by the lockdown winners, like tech and healthcare. And as the S&P in the US has a higher allocation to tech and healthcare, so the S&P has recovered faster than Europe or Japan. And emerging markets with the lowest allocation to tech and healthcare have bounced the lowest. In between, you can see there our bond index, which has recovered nicely and is slightly positive for the year, 4%, cash at 2%, and MSCI and Rands being your best equity performance, with the Rand helping that asset class. The one that is quite different is oil. You can see that oil is the second worst asset class year to date, down 8%, but with the biggest bounce. It's bounced 52% from its lows over the last 3 months. That hasn't been so much the fact that we're seeing increased demand. It's still one of the biggest lockdown losers. It's because supply has been cut. Saudi is now producing the lowest level of oil since 1991, since the Gulf War. That's an incredible cut in supply that's coming out of Saudi Arabia, and that reduction in supply has helped balance the oil market and pushed oil back up into the low $40 per barrel. So that's more an anomaly in terms of the supply impact to that asset class. But it has helped stabilize emerging markets, the bounce in oil. But overall, markets functioning, the differentiation between lockdown winners and lockdown losers continues. Certainly, lockdown losers are continuing to price in strong headwinds, whereas lockdown winners are still seen as a safe haven, the dollar, tech, and healthcare stocks being the best performing sectors for the first 6 months of the year. I'm going to rush through the next 2 slides because I have spoken about them in the last 2 webinars. But what's allowed markets to recover and at least function correctly is the huge amount of monetary and fiscal support, and that continues. So the chart here on the left is the amount of quantitative easing that's being pumped into markets. You can see there we're still over $1 trillion a month of bonds that are being bought by central banks, dwarfing the amount of bonds that were bought by central banks in the great financial crisis of 2008, 2009. So huge amounts of liquidity being pushed into the banks, being pushed into markets, keeping markets buoyant, and that money has to go somewhere. A lot of it doesn't filter through into the economy because banks don't want to pass on that money, but it's certainly filtering into markets and keeping equity markets and bond markets much stronger than we otherwise expect. And once again, we don't expect, I mean, as you can see on this chart in general, it was only towards the end of 2018, early 2019, when there was some negative QE, or central banks actually started to sell some of the bonds that they had, and markets rioted very badly. So we don't think, we still believe in the Japanification roadmap, and they've been buying bonds the last 23 years. We think governments in the developed world are going to continue this trend of buying bonds. Sure, it will come down as expected, but highly unlikely we're going to see an unwind of those central bank purchases, which will provide continued support for markets, continued distortion of bond markets, continued support for property and equity markets. Similarly, on the fiscal side, chart on the left shows the huge amount of debt that governments are taking on. That's the debt to GDP back to World War II levels because of the huge amount of support that's required due to the lockdowns. The US, 15% of GDP, Japan, 22% of GDP, massive, massive amounts of debt being taken on to support economies. But once again, that's just stealing spending from the future. It's got to be paid back at some point. It will mean lower growth over the next decade. So once again, avoiding a hell that's forcing us to be in purgatory for the next decade as we slowly unwind those huge amounts of debt. Again, reinforcing the Japanification roadmap, low growth, high volatility. Looking locally in South Africa, we had another first. I mean, the world is filled with firsts, quantitative easing and special adjustment budgets that happened last week in South Africa. Tito had to come out and give us an update on the budget because things are looking so different from the February budget. In February, we were expecting the debt to GDP in South Africa to be 65.6% this year. So 66% debt to GDP was expected for 2020, 2021. That's been increased to 82%. That's a massive increase in debt. It's due to the biggest budget deficit we've had, 14.6%. There's huge shortfalls in tax revenues because of COVID-19, plus extra spending to support consumers and to support businesses that have been hurt by the lockdown. As a result, a lot of debt being taken on in South Africa. The chart on the right shows that the rapid increase that we've seen in debt in South Africa from 2016 to 2020. So rising from 50% of GDP up to now 82% of GDP, a huge increase over the last 4 or 5 years. Particularly as a result of spending that happened under the Zuma administration. Now, Tito came out to say the government's looked at what they've been doing. And if they carry on doing things the way they have, then debt to GDP is just going to escalate in this passive scenario. We're going to be stuck in a downward spiral where we actually spend all our revenue paying interest, and we'll be forced to default. It's a completely untenable scenario and something has to be done. So they have, once again, promised structural reforms, once again saying that they'll do what needs to be done to promote growth and to reduce debt. So that's this active scenario at the bottom line here on the chart, where they predict debt still to increase to our highest levels ever, 87%. By 2023, but then to finally consolidate and lower it down to 74% in 8 or 9 years' time. So that's very exciting, and we truly hope that can be done. However, Moody's came out very quickly to say that it's very difficult to achieve that active scenario. Over the last 3 years, we've been promised a number of structural reforms under Cyril, and we haven't seen anything come through. SAA, which gave us some hope, has been once again been delayed until the 14th of July as the unions continue to push back on the proposed plan. So we're not getting a lot of comfort that those structural reforms are going to happen. Certainly, there's little evidence looking at what's happened up to now, and Moody's doesn't believe it. However, it has to happen. So there is a decent chance that the desperate position we find ourselves in is going to give the government sufficient ammunition to get this through. And certainly the zero budgeting, which they plan to do for the October medium-term budget policy statement, where they're starting from scratch. They're not taking last year's budget and building on that in terms of how much spending. Everyone has to start from scratch and defend how much they need. That is a great tool that can be used to achieve this active scenario. Certainly the RAND doesn't believe it. The RAND is pricing in structural default. The RAND believes that there's no way we're going to achieve this active scenario. And most likely we are going to fall somewhere between the two scenarios, as we don't get quite as much as we want, but certainly have to do better than we have over the last decade. We also are a small open economy, and we need to remember that we are at the mercy of global markets, we're at the mercy of global growth, we're at the mercy of commodity prices. And we have seen a strong improvement in our terms of trade with precious metals prices going up, and all prices being relatively strong compared to oil, which we import, which has been very weak. And that does help our revenue scenario quite a lot, and it does help our growth quite a lot. So given the external factors, we only need a small improvement in the external factors to help us pay down some of this debt and move onto the active scenario. So yes, we're reliant on the government for structural reforms, but we're also highly reliant on the global environment. And we have had trade wars for the last 2 years. We have had COVID-19, which has been a massive headwind to emerging markets in South Africa in particular. But if we do see a weaker dollar, and I'll touch on this later on, it could certainly help us achieve this active scenario even more than the structural reforms from the government. Looking at other details within South Africa, we've seen level 3 from 1st of July, 8 million people returning to work, an exponential increase in the number of positive COVID-19 cases. Hotspots seem to be moving out of the Western Cape, which has peaked about 2 weeks ago in terms of hospitalization rates, and has moved to Gauteng, which is still increasing. It hasn't seen a peak yet. So we are seeing a shifting of the location of COVID-19 within South Africa. But once again, hospital utilization rates are lower than expected, and hopefully that'll keep us out of returning to stringent lockdowns and allow the economy to continue growing. Certainly that's what the government seems to be indicating, with further relaxation of restaurants and personal health care being allowed over the last week or two, despite the fact that we haven't even reached our peak infection rates. I think that's symptomatic of the world over, where we're seeing these hotspots, we're seeing emerging markets, in particular India, Brazil, Mexico, South Africa, being behind the curve. They're late into the first wave, but at the same time, they're still actually unwinding the lockdowns, not increasing them. One of the big reasons for the lockdowns was to prepare hospitals. And if the hospital utilization rates are lower than expected, then there's no need to force those lockdowns back on. The other positive for South Africa, again, I mentioned that we are a small open economy. 40% of our bonds and equities are held by foreigners. We're very dependent on global monetary conditions. The huge amount of global monetary support is driving the search for yield, and search for yield makes South African bonds look very, very attractive. In 5 or 6% dollar yields, currency hedged, far more exciting than buying European bonds at 0%, US bonds at 0%, or Japanese bonds at 0%. So the combination of higher commodity prices, the fact that we might see a weaker dollar, high yields within South Africa, and the search for yield continuing, all positive global influences that we are expected to support South Africa, despite the negative internal issues that we are having, and the lack of structural reforms that we've seen so far. So not saying that it's time to get into South Africa yet on the equity side, but certainly as the world comes out of this global recession, we will start to see a lot of headwinds from a global perspective become tailwinds. Okay, so let's look at risk management and the factors that are driving our tactical asset allocation decisions. So the two primary drivers of our asset allocation are monetary and fiscal. The two factors that drive markets are surprises to liquidity, in fact, or how much it costs to hold an instrument, and surprises to growth, what the earnings are going to do over the future. The markets tend to be quite efficient in their price in a lot of the given scenario, but surprises to liquidity, surprises to growth are important. We continue to see upside to fiscal support as countries roll out growth measures. We can continue to see upside to liquidity as central banks buy more bonds. Both of those are positive for risk in terms of driving a risk-on environment, moving into equities, moving into credit, and moving into cyclicals and emerging markets. The third factor, which has been around for the last 6 months, is this COVID-19 virus. We're getting closer and closer to a vaccine in December. We're now only 4 or 5 months away from a potential vaccine. So markets are going to look through the potential for lockdowns. Even if there is a lockdown over the next 4 or 5 months, it's likely to be very isolated due to low hospitalization rates, due to the fact that we are only seeing increases in isolated regions. So positive base case scenario from the virus. Certainly, there will be lots of volatility, and as we see increases in various states, Texas and Arizona, Florida, and as there are some rolling back of the lockdown exiting measures, markets will come off. But generally, expect markets to look through this over the next 5 months and be relatively positive. So the next big thing is the US elections. That's the biggest unknown over the next 5 months, besides COVID-19 and when a vaccine arrives. And that's all about Trump. So the chart on the right shows the betting odds for Trump versus Biden. So this you can see here, the blue line is Biden. He had longer odds than Trump for the last 2 years, and it's only in the last 2 weeks that we've seen Biden having stronger odds than Trump in terms of winning the US elections. And the result, we have seen the dollar start to weaken, and the Democrats are more than likely to lead to a weaker dollar than if Trump is re-elected in November. But let's look more generally at the dollar. So why is the dollar important? Well, the dollar makes up 80% of external debt for emerging markets. Commodity prices are all priced in dollars. Most of emerging markets use dollars for their working capital. So if they want to put an order to buy a widget, they have to pay for that widget in dollars, and they need to borrow dollars to put down that working capital. The dollar makes up 2/3 of the global world's currency reserves. 90% of every transaction in the forex market, one side is the dollar. So the dollar is very, very important in terms of global trade. It's also seen as the risk-free asset for building any pricing models. You start with the dollar. From the dollar, you move into US bonds, US treasuries. From there, you use bonds in your own country, which gives you a risk premium for your equities, and so forth in terms of building various pricing models. So understanding the strength of the dollar, understanding the cost of borrowing in dollars is very important. The dollar tends to move in cycles that vary from 7 to 10 years. On average, it's a 9-year cycle. We are 9 years into a strengthening cycle. If you remember the previous decade, in the 2000s, 2003 to 2009, we had a very weak dollar, and that was coincident with very strong rest of world growth. Emerging markets had very, very strong returns. Commodities did very well. There was a boom in China, boom in South Africa, boom in all commodity countries. Then for the last decade, we've had the reverse. We had a very strong dollar driven by more of a risk-off environment, driven by strong US tech, driven by weak rest of world growth. And it's a bit of a circular reference. Rest of world growth leads to a weak dollar. Weak dollar allows rest of the world to grow stronger, and that's why the cycles tend to last nearly a decade. But being year 9 of a strong dollar, we are historically close to a top. It doesn't mean that we're calling it a top, but we are close to a top. The dollar has strengthened 40% over the last decade relative to its trade-weighted index. So you can see a lot of strength that has come through, and it does mean it's more expensive for the US well, they become less productive in terms of a stronger dollar. If you look at their purchasing power parity, the IMF suggests the dollar is somewhere between 10% and 20% overvalued. So certainly from a longer term fundamental inflation-driven perspective, the dollar is too strong. The other thing that you can look at to price the dollar is interest rate differentials. This is more short-term. It also suggests because the US has cut interest rates so dramatically, and as the US 10-year bonds have driven close to zero, like Japan and Europe, there's not as much need to hold, or it's not as attractive to hold US bonds, which again means less demand for dollars. The twin deficit is another headwind for the US. That generally means if you have both a negative budget account and a negative current account, you have to finance those by borrowing money offshore, which again means it's a negative for the dollar. Similarly, the US's net international investment position continues to worsen, which is a headwind to the dollar. One of the things that's been structurally quite good for the dollar has been the US shale industry. So the US has gone over the last decade from being a major oil importer to completely energy self-sufficient. And that's been allowed by the shale industry. But the shale industry is the highest cost producer in the world, close to $70 a barrel, whereas Saudi and Russia are on $40 a barrel. So the low oil price that we're seeing is going to lead to a shutdown in shale production to force the US to import oil, and will again impact the terms of trade and be a headwind to the dollar. Quite an interesting one is the fact that the ECB is now come out fighting for other countries' foreign reserves. So for the first time in history, the ECB has set up a repo facility for non-Eurozone banks. China did that last year, and that now means that countries like South Africa can, instead of being forced to buy dollars, it's very attractive for them to buy euros or to buy renminbi, because they can access a liquidity facility through the ECB repo facility. So this is quite important, because it means that ECB is now fighting for dollar reserves, and it may allow other countries to hold more euros and more renminbi and less dollars, and then change that the entire dollar reserve basis away from the US. So generally, we're seeing a lot of headwinds building for the dollar. These are all known knowns. They're all priced in, and what we have seen some dollar weakness over the last month or two. The only unknown is the US elections, and for now, and the COVID-19. So for now, the dollar is going to remain strong because it is the global safe haven. But as we move closer and closer to these elections in November, if the probability for a Democrat win increases, it's likely to see further dollar weakness, which will be very good for South Africa, very good for commodities, very good for emerging markets, very good for rest of the world global growth. And it's something we need to watch quite closely. Of course, at the same time, if Trump's probability increases, and if he starts saber rattling and starting trade wars again against China, or threatening sanctions or other things to try and build his support base to win the elections, that could lead to a stronger dollar, which would be clearly negative for emerging markets, negative for the rand, negative for global growth. So we need to balance that, and it's the two big unknowns that we are watching. It's the COVID-19 and it's Trump and his impact on the dollar as we move forward. As a result, we have taken a small underweight position in US equities. We've got a small overweight EM position, because we do think that the likelihood at the moment is a weaker dollar. We don't know when the catalyst is going to be, but we do know that the dollar is overvalued because of the safe haven. We do think we're going to move into a more risk-on environment as you look through the COVID-19 recession. While Trump is behind on the polls, it doesn't necessarily mean he was also behind on the polls the last elections, and he still won, so it doesn't mean much. But that volatility means that we have started to take a small position in emerging markets versus the US. The US is still 66% of MSCI world, so small underweight doesn't make a big difference. We are about 60% instead of 66%. Still the US being our biggest position, but starting to tactically move away in case the dollar does weaken over the next 6 months. Looking at our portfolio position, I've spoken many times about planification, the fact that COVID-19 has accelerated our roadmap for a low growth, high volatility world. Chart on the right here, I've just tried to show what's happened in Japan. So I've benchmarked this to 100 in 1997, so 23 years ago, when Japan started quantitative easing for the first time. So they're now 23 years into QE. The US is now 10 years into QE. Europe, although they're only 8 years into QE, they have got an older population. They started their aging demographics and a shrinking labor force much earlier than the US. So a combination of aging demographics and QE is the key to this Japanification roadmap. But anyway, looking at Japan in the last 23 years, the green line shows the yields on their bonds. So you can see that despite hugely increasing amounts of debt, and their debt is nearly double the amount of, well, it's more than double the amount of debt to GDP compared to other developed markets in the world. Despite that huge amount of debt, their bond yields have continued to get closer and closer to zero. Partly that's been allowed by the Bank of Japan buying those bonds, and they now own nearly half of their own bonds. But it's also because deflation has been the predominant environment. They've been fighting for inflation over the last 30 years. Over the last 23 years, they've been using QE to try and allow huge amounts of fiscal support, building roads and railways, to get inflation, to help them grow. But that inflation hasn't come through. They've been stuck in a disinflation environment. And you can see they're clearly here on this yellow line, which is Japan's nominal GDP. So that's their real GDP plus inflation. It's flat. Over the last 23 years, despite all the spending they've doubled their debt to GDP. They've used that very wisely. They haven't spent it on clothing and cars and other things. They've invested it wisely into roads and railways and productive assets. Although you can question whether building a second railway next to a first railway is that productive, but it has been relatively productive assets. But despite that huge increase in debt, their debt to GDP has gone nowhere over 23 years. The equity market has had a slightly positive return, which is good, but you can see they're very volatile, with the white line falling nearly 50%, then doubling and falling before finding slightly positive returns, nearly what's close to 1% a year over the last 23 years. Not great returns from the equity market. And we see that being a strong roadmap for mostly Europe. We've got the oldest population, or the most shrinking workforce. Then the US, which is also seeing some shrinking workforce, which is being accelerated by the fact that they've stopped immigration, but also the increasing levels of debt. And the developed world as a whole is moving into this low growth, high volatility environment. The emerging markets are slightly different. We aren't seeing disinflation. Even in South Africa, despite low inflation at 3.5%, we still are positive in inflation, which is structurally very beneficial for emerging markets. It does help us grow out of debt. It does help people spend more rather than save, because TV is going to cost more next month than this month, so you may as well buy a TV this month and not delay your purchases. So it's generally quite positive and will help emerging markets recover faster than developed markets. And it's another reason why structurally we do believe that emerging markets will see stronger tailwinds over the next decade. However, in the short term, tactically, we are still underweight South African equities. There's still a lot of headwinds locally. We need to see strong structural reforms come through in October before we can have any confidence that growth is going to recover, that jobs are going to recover. And that's the big thing. We need job growth in South Africa. In March, we saw the 17-year high in unemployment of over 30% in South Africa. And that's before the lockdown even took place. So we now, GDP is expected to have fallen 28% in the second quarter. There's huge job losses. We don't know what those numbers look like, but we certainly need a lot to happen. So if towards the end of the year we start to see global growth picking up, commodity prices stay strong, the dollar weakens, structural reforms happen in South Africa, then those will all be key catalysts that will allow us to move back and go overweight South Africa. We are definitely moving in the right direction, but for now we're staying underweight. We are overweight global equities, and we do think that the rand is your best shock absorber, but we do have protection in case the rand strengthens. And our base case view, again, as we move out of this risk-off scenario, as we look through COVID-19, possibly driven by a weaker dollar, is that the rand will strengthen towards maybe 16.5 by the end of the year. Not much stronger than we are now at 17, but certainly a lot stronger than we were at 19.5, which was the weakest 3 months ago. So again, protection on that, but staying overweight to benefit from diversified growth globally. Continue to avoid global bonds because QE distorts Japanese bonds, QE distorts European bonds, QE distorts US bonds, and we're much more excited about holding our impact portfolio, our ESG fund, which is again a diversified source of return, very important for a low growth environment. And finally, on the local front, because of the 3% rate cuts, which is very great for the economy and will stimulate the economy and probably pumped 100 billion rand into our local economy, it is bad for an investment. If you want to hold cash or you want to hold income assets, you're earning 3% less than you were a year ago. So we have reduced those two asset classes and we prefer holding government bonds. The SA yield curve is the steepest it's been in history. If you invest in the bond index, you're earning 5% more than if you're earning in cash. And the reason for that is because the huge amount of bonds that have to be issued by the South African government to pay for all this debt. So how do you go from 66% debt to GDP to 82%? Where you've got to issue 15% of GDP worth of bonds. Like the government, fortunately, Treasury is getting quite clever. They're not doing it all through South African bonds. They're doing some offshore, they're using some cash reserves, but they have still led to a huge increase in bond supply. Increase in bond supply has led to bond steepness of the curve, which results in bonds remaining an attractive asset class. Yes, a lot of volatility could be expected, and so it's definitely not a risk-free. But when you're getting an extra 5% return, it's probably worth taking on that additional risk in a small amount. So we've got 2.5% less cash than we had before, and 2.5% more bonds, just on the edges to get our yield up without taking on too much additional risk. But we believe that risk is well warranted given the extra return available. And that summarizes our overall view. Structurally, we're stuck in a low growth, high volatility environment. Tactically, we are underweight equities and overweight local bonds, which we're seeing is giving a great risk adjusted return. We do think that we'll move towards the end of the year into a better scenario as we look through the virus, but in the short term, there will be volatility. We think volatility will continue. There'll be better buying opportunities than today. There'll be better selling opportunities than today. And so we have to stay nimble. We have to continue harnessing the volatility that is available. And we will keep monitoring the portfolios and making sure that we optimize them for the low growth, high volatility environment. Thank you. Okay, just one question, which is nice, short and sweet. Just asking about our tactical underweight in the US and the size that will be. As I mentioned, it's about 5% at the moment of our global portfolio. Global equities make around 22% on average of our balanced funds. So it's about 1% of the overall portfolio. So very small at this point. We might take that at a maximum from 1% of our overall portfolio down to underweight of 5%. The US structurally is still our preferred region in the world. They've got the highest productivity. They still have the highest inflation compared to Japan and Europe. Tech remains a structural overweight in our funds. We still like tech, FANG stocks. We still like our fourth industrial revolution stocks, and we like healthcare stocks. So expected, although we're waiting for the FSCA, expected on 1 August, we'll be launching a new unit trust locally, which will invest in the MSCI Healthcare Index. We believe that healthcare is, again, a structural sector that we think will have structural growth going forward as aging populations will force for higher spend at hospitals and drugs, pharma companies. And so we'd like our funds to be able to access that asset class. So while we are concerned about the US from a dollar perspective, we do structurally like tech, we do structurally like healthcare, and we will maintain overweights to those sectors within the US They are, granted, they are very expensive at the moment, but structurally we think that there is growth in those two sectors. So we would never take, or we're unlikely to take the US underweight more than 5% because of those structural growth aspects. But given a weaker dollar, we could increase our underweight from 1 to 5%. Another question on bonds versus equities. So right now we are underweight SA equities, overweight bonds. Two things could change that. If the global environment improves over the next 6 months, because we have a vaccine, because global monetary support and fiscal support is still in place, that will be very positive for growth. And if we see structural reforms in South Africa, then certainly yes, we're likely to increase our weight in SA equities. On the bond side, we're unlikely to reduce that unless we see a bond yield strengthen very strongly, which could happen, or in 12 or 18 months' time, we start to see interest rates rise, in which case cash might then be more attractive relative to bonds. But for now, we don't expect interest rates to rise for at least the next 12 to 18 months, because inflation is going to be structurally low in South Africa. Growth in South Africa is so low that the pass-through inflation has been practically zero. So a decade ago, when the rand would weaken, you'd have strong pass-through inflation. People would carry on buying TVs and cell phones. Now, when the rand weakened, there's so little growth. The demand is so weak that people just stop buying. And as a result, inflation, pass-through inflation from either high oil prices or weak currencies, that it doesn't exist. And so we are expecting inflation to stay low, which should keep interest rates low, and which is good for supporting our growth, and but at the same time, we'll keep cash as an unattractive asset class. Yeah, generally, as part of the Japanification story, we do want to stay diversified. I mean, equities will give you your best return over the long term, but will be more volatile in the past, with a lower return in the past. So access to credit is very important. And so structurally, we keep our SA income fund, Sygnia Enhanced Income Fund, as a core holding in our portfolios. We are slightly underweight, 8% versus 10%, but you do need that diversification from credit. Globally, you do need alternative assets, which is why we do have our OSI Impact Fund. And it's very important to diversify portfolios in a low return, high volatility environment. And that's it for now. So we are running out of time. So thank you very much for listening. Thank you very much for your questions, and good luck for the next month.